Hi everyone, Dale Pinkert here, TradeGateHub.com, powered by TradeView Markets, a broker for people outside of the U.S. I have Julian Brigden with me at MI2 Partners. Julian, great to have you here. I appreciate your time. I know markets are pretty hectic lately. Great call on the S&P from the last time we talked in early December.
Thank you, Dale.
Yeah, real nice trade. Do you maintain your bearish stance on the S&Ps here?
I do.
Okay, so you're willing to ride out rallies?
No, I mean, I think you trade rallies, right? I mean, the
Yeah.
approach that we've adopted is to buy some sort of longer dated 25 sort of delta, 20 delta puts.
Yeah.
And then trade the gamma.
Okay.
And because this market still desperately wants to believe that somehow the 7th Cavalry is coming to the rescue. And I'm afraid that's not the case. The cavalry can't come to the rescue. And people need to be, need to realize that. I think
the game has changed.
The game has utterly changed, Dale. Yeah. And I'm afraid, when I look at things from a macro perspective, there's a phenomenon that we talk about called hyper-financialization.
It's all one market. Is that what you're going to say?
Well, not just that, actually. It's worse than that, Dale. It really is, I'm afraid, worse than that. The correlation between the real economy and the financial economy is essentially one, whereby if you're the Fed and your real target now is, look, headline inflation is peaking, okay? Yeah. Core inflation is essentially a phenomena of wages if you're not careful, right? So you have to reduce and level off the demand in the labor market. And the problem is in a hyper-financialized world, the labor is a function actually of the equity market. So if your clients can pull up,
that's what you mean.
The S&P, and then you look at the JOLTS data, Dale.
Yeah.
It's the same bloody chart.
Interesting.
Which basically means that if the Fed wants to get this labor market back to being balanced, which it hasn't been since COVID, you essentially need to get the S&P down to 3,000.
Right. So, that's still your long-term target. It's a very interesting target because for people that, weren't around for COVID, it basically, when you talk about the S&P, it's back here. This was the COVID crash, and the high of this range was about 3,400. So you're looking for, where it all began, for it to give up the whole. Or
I mean, essentially, yeah. I mean, and I've got, if I look at mine, and I look at, I've got a weekly trend line that comes off the low of 09, and then sort of intersects with the lows that we saw in sort of 19, and also in that sort of 11th, 12th period. And that basically comes in, I mean, right here, right now, it comes in at just above, 3,000 and change.
Okay.
So yeah, that's kind of what I'm looking for.
Look how important this 3,600 level was. We had weekly 200 week, was set up tactically for a rally here. Normally, after a big trend break, sometimes it'll rally back, Julian, to where the trend broke, which is 3940.
Right. I'd love it. I mean, the one that actually really worries me the most, to be brutally honest, is the NASDAQ. I think that's where the money is still hiding. I mean, you can see it in the price action of, something like Apple, right? I mean, we've written to our clients about Apple that somehow people believe it's this sort of mystical creature, this creature that has equity type returns and then bond like protection. And they're basing that thesis, Dale, on the price action of Apple during COVID, right? It just exploded higher. They're forgetting that the reason it exploded higher was that the Fed printed $4.75 trillion. Right? Now the Fed is taking that money out of the system. And I, for one, believe Look, I think the Fed desperately at some point after this next rate hike would like to scale back the size of the rate hikes.
There are some people talking that they're only going to go 50 in November. You think they'll still go 75?
It's difficult to know. Look, we've got a fair bit of data to go still before then, and I think some of the data is moving in their direction. Mm-hmm. But the point is, Dale, that it's not necessarily rate hikes that are the biggest threat. The biggest threat to this market is QT.
Okay. Who's buying? Who's on the other side of QT?
I mean,
who's buying their runoff?
Well, it's not so much the bonds, right? I mean, actually, if you look back in history, through most of QE, you know, whether it's QE1 was a little different, right? I mean, we had literally collapsed the U.S. banking system and the sort of liquidity provided by the U.S. banking system. If you think of liquidity as sitting in a bucket, right? That's the U.S. economy. We'd blown a hole in the side of the bucket, right? So the Fed had to come along, patch the bucket, and fill the bucket up, right? So that wasn't extra liquidity. That was just getting us back to kind of stability. But in every subsequent wave of QE, stocks rallied because it says on the tin, when you buy a can of QE, it says caution liquidity, reflation, right?
Yeah.
So stocks rallied and bonds sold off, right?
They're still
bonds
doing
sold
so.
off. Well, now the problem, I think, is these fiscal deficits.
Right. Here's TLT. I mean, people talk about a bear market in equities.
Oh,
this is where the crash is
bloody brutal.
It's going to lead to a pension crisis, a lot of people think. I just want to go back to Apple for a second, Julian, just to give you some parameters. When I see some moving averages converge like this, I think it's possible that people will become more convinced and that this still could be a failing rally, but it could rally up to near 160.
Well, all I'll say is, look, I think that the Fed, as I said, I don't think people realize the degree of determination and the pain that is necessary to get inflation down, Dale, right?
Yeah.
I truly think, look, 4.4% is the number for unemployment the Fed has in their SEP forecasts, okay?
Right. Yeah.
The low we saw in unemployment was 3.5. We've never had an increase of 0.5 or more without a recession. So quietly, in their own way, because they can't come out because they have an employment mandate and say, we are driving this economy into recession. That's precisely what the Fed. No, and it doesn't stop there, Dale. That's the problem. Yeah. If you look at a chart of unemployment, right, and you take this thing back many, many, many years, okay, what you'll see is unemployment looks like a mountain range, okay? So it rises, steadily rises, right, because one job loss begets another job loss, begets another job loss, until you hit a sharp peak. And then it tends to base slowly like a mountain sort of valley floor. And as soon as you start to lose momentum, unless they come back in again and re-ease, Dale, which is hard to imagine, right? We won't stop at 4.4.
Okay. What do you think about gold being on the brink of a important breakout? Is it giving me a message? Technically, it gave me a message when it negated the big breakdown here at 1680.
I like it. The problem I've got is I just don't know whether the dollar run is over, right? I mean, this silver, look, I'm a bit annoyed with myself, right? How quickly this silver thing broke out. I've been looking for it. I missed it, just too much other stuff going on, right? And silver, to be honest, for the majority of my clients is a sort of, afterthought, right? I've got some in my portfolio. It's great. It's fine. But, and I've held it for a long time and it's done nothing. I get suspicious when you get such aggressive breakouts. To me, that says to me, this is not really a sustainable breakout. And I look at the dollar, Dale, and we had a discussion about this before, right?
Yeah.
I look at the stuff that's going on in continental Europe.
Yeah.
And I am sorry. I think you are looking at a recession, the like of which we have not potentially seen in 30 years in Europe. And I just can't get bullish on the euro. I mean, I'll share you a chart of
okay, I'm going to stop sharing and let you share.
Okay, so this is European consumer confidence.
Yeah, I'm sure it's in the toilet.
No. I mean, not just in the toilet, mate, right?
Oh,
I
you mean down the drain already? Yeah.
Yeah, I mean, halfway out to sea.
You know how here it comes. Okay.
Look.
Wow.
So, right? I mean,
yeah.
this was the post ERM collapse recession.
Yeah. Yeah.
This is the GFC.
Right.
This is the sovereign crisis.
Yeah.
This is COVID.
Right. Yeah.
Right?
These are historic readings.
I mean, these are just historic readings. I mean, forward models for things like German industrial production.
Yeah.
Those are my models.
Okay.
Minus 26% year over year industrial production collapse.
Okay.
Minus 26%. How, Dale? I can't get bullish. And oh, by the way, in a horribly inflationary environment, because they've still got massive inflation pressures, I can't get bullish on the currency. So I find it very, very hard. To my mind, I think we're probably going down to 80 on the euro.
Okay.
And everyone tries to keep buying the dip.
Yeah, I'm one of them.
I know. I didn't want to say that, mate. I know you've had a stab at it.
I actually have been talking about, and it's really been poo-pooed about that. There's a need for concerted central bank intervention. It would
not happening,
mate. Because it's not the dollar's not just affecting what's happening here.
Let me show you. Yeah, let me show you another chart, which I think is important, because I think it's important for people to get context of how this works. The Fed doesn't have a remit for the rest of the world, right? It just doesn't. It has a remit in the US. It has an inflation. Biden has told Powell to go and address inflation. And you need to look how this sort of stuff has panned out in the past. So this is 1997, 1998. Okay, this is the Asian crisis for those of your clients who don't know. This was a massive problem in the world, right?
Thai baht
starts in the spring of 1997. Okay, Thai baht devalues, Philippine peso devalues, right? Hong Kong has to defend the peg, Korean won floats, right? All the way through. Then it goes from Asia into Europe, right? Russia collapses, stock market collapses, ruble devalues, BOJ has to intervene to support the yen again, right?
It's really rhyming.
Yeah, but the point is, Dale, this whole process was over 18 months, right? Yeah. And the only thing that caused the Fed to care was a precipitous decline in the US equity market as LTCM, which was a big hedge fund back then, threatened to bring down the US banking system.
Yeah.
And the Fed got together all the US banks in a meeting, arranged a bailout, right? And then had to go in and cut rates to support the market. They literally didn't care as all of this stuff blew up.
That's really a good point.
Right? And until it showed up on US shores, they just didn't care. And I think the way that it shows up on US shores this time is once again the same way. A sizable decline in the US equity market.
Okay, which is their goal. First of all, we have to get there to take down, and like you're saying, we're so super financialized that 3,000 S&P will give them their unemployment targets or their employment targets, right?
Essentially, yes, I'm afraid so.
Okay.
You know,
All
maybe
right.
they blink before, but if they blink before, then disinflation is going to remain ingrained. But
Okay.
I think that's the target, and I don't sense any that they're backing off in any way, shape, or form at this point, Dale.
Okay. So, even if I think the first one to be challenged because of market action, actually, intervention level wise, is going to be the yen, because we're not that far away, and the yen made very little progress, Julian, during the dollar sell-off, and
Yeah.
it was a decent sell-off, but the yen
I mean,
didn't
even
move.
there, no, even there, look, because the fundamentals haven't changed, Dale, right? I mean, you look at what both the Bank of England essentially and the BOJ
Yeah.
did currency intervention, right?
Right.
Directly, obviously, on behalf of MOF, the BOJ, because my understanding is there were a lot of structures above 145 from major Japanese companies that would have incurred accelerative losses because of the way these things were structured, and could have threatened the solvency of some major Japanese corporate names.
Well, we're almost there again, Julian. We're at
because they
44.
haven't changed the fundamentals, Dale.
Right.
Remember, they're still doing QE, and we're doing QT. And if you chart the relative balance sheets against the currency, it's pretty much the same thing. I think both the Bank of England's move in the gilt market and the BOJ move is really designed as a speed bump and not a top or a bottom, right?
Okay.
Because
it was a very good rally. I mean, you're
Yeah.
talking, and some wave guys said, if you take out 114, this was their argument, okay, is when we left Friday,
Yep.
this looked like it could be a bear market rally, a little, A,
Yep.
B, C, and then down. But this last extension changed the character of it, that I'm actually thinking about buying breaks if cable pulled back to 109 or so.
Yeah, and it's possible, but I just, to me, the euro, we said this before, until you get back up above like that 103.5.
Yeah.
This to me, I think I look at this long term. I think we're going back to the early 2000 lows.
That was the last intervention. They did intervene all the way back then.
Yeah, in the low 80s.
Yeah, exactly. Okay.
I mean, that's my gut. That's my gut, because I just think the macro just looks horrible. The only way it wouldn't happen, the only way it wouldn't happen is if you really do get foreign money leave the US equity market.
Okay.
Right? Because that's where it all is. All the rest of the world's money remains in the US market. So if you've got a situation where you've got this precipitous accelerative decline in the US equity market and foreigners take their money home, you'd get a really ugly situation where you'd get the dollar down and the S&P down.
Any thoughts on the fact that normally it's the emerging market currencies that really take it on a chin, and they've held up on a relative
remarkably
basis
well,
much
actually,
better? Yeah,
Dale, remarkably well.
I haven't seen that in a long time.
No, I just don't think there's as much money there as there has been. I mean, they were shunned as a place, right? I mean, to invest for a while, right? The US is where all the global capital is. Let me just show you one last chart just to illustrate a point, because I think it's just a really, and I've tweeted this occasionally, but I think people need to understand the magnitude of what's going on, right? So this is the MSCI US, so basically a broad metric of the US equity market against the rest of the world ex the US. Right, so let's go back to 1970. We hit a 5 standard deviation away from the mean, right? And we're still at 3.5, right?
Yeah.
I mean, we've never seen in basically 50 years, we've never seen the US equity market on a relative basis this overvalued, and it is still extraordinarily overvalued.
Does it make you want to start dropping some money into the emerging markets?
Not yet, because you need to get that. You need to get that VAR event, right? You need to get that risk off. Nothing works. Everything pukes. event, right?
Yeah. Okay. So a lot of people are saying that we may be there, by the end of the year. Some people are
Maybe.
saying we may hold for a few months here and give you better levels to short at, Julian, which is my view right here. I think there's a chance of 4% yield. And here's Julian's website. You guys have to go there and check it out and check out his newsletter. And as you can see, you're just getting a sample of the kind of historical viewpoint. Julian's got one of the best telescopes in the industry. So, if you want to know some macro and how to be tactical about it, go there. But
And I think
just
it's very powerful, Dale, when you combine, your thoughts with the, look, I've got lots and lots of big clients, and they use macro because it anchors the view.
Right.
Right. It anchors the view. I mean, if you look at this data, it's like the inflation data, right? We were hugely aggressive inflation bulls, starting in early 2021, late 2020. And we basically played that game the whole way. And so what it does is when you look at a chart of, say, 10-year treasury yields or whatever the heck you wanted to look at, it just meant that you were sellers on every single rally in the treasury market looking for higher and higher yields if you've got that fundamental anchor.
And it was a good one to have, because if you were bullish, you had a different type of anchor that took you
down to Davy Jones's locker, right?
Yeah, right. Without oxygen tanks. Yeah, great point. And I'm just thinking tomorrow, you have any expectations on the NFP for tomorrow?
It's a tough one. It's a tough one because there's a big the BLS has, the Bureau of Labor Statistics, who compile this data. They play some games with some seasonal factors, and I'm not saying they do it. I'm not getting Machiavellian about this and suggesting it's intentional. It's been very difficult to apply seasonal adjustments to what is a very unusual labor market, Dale. I think we'd agree that the standard seasonal patterns just don't hold water, right? There is quite a large rump of seasonal adjustment that they have to apply that could drag the number down, right? So if you're looking for your trigger for another rally in equities, this bad news is good news,
right?
That
it'll come in a little lighter.
That could come in a little lighter.
Because
I never try and forecast NFP.
Yeah.
It's like juggling with chainsaws as far as I'm concerned, right?
All right, and that's dangerous too. So I'm just thinking that we could have a failing rally here and then yields drop again towards 320. And I just want to leave with one thought, that we could throw all our research out the window if there's an escalation in Ukraine.
Well, God help us not, right?
Yeah. So I'm just wondering if everyone should go out and own 5,000 bushels of wheat and look to take delivery of it.
Yeah, exactly. Thresh them in your garage. There you go.
Because that would irradiate the breadbasket of Ukraine for forever. And
I don't think we're going to a full-on blown thermonuclear war. And I would hope he's got. I mean, if you watched him when Putin came back from his summit with the sort of non-aligned Xi and Modi, he kind of came back with his tail between his legs. I think it was pretty clearly told, don't even bloody think about it. But it's dangerous, right? Because
he's desperate.
He's desperate, right? Their military is not performing brilliantly well.
Yeah. Anyway, so we do the right things today, and tomorrow takes care of itself. Julian, thanks for crystallizing some things for me and tempering my enthusiasm for the euro.
Yeah, look, as I said, I mean, in a super risk off, like literally collapsing equity market environment, you could get a bizarre situation where the euro actually rallies and the Swiss franc rally because money that is invested by those overseas investors goes home.
Yeah.
But until then, I'm afraid I look at the macro picture in Europe and Dale, it's horrible, mate. It's
Okay, well,
horrible.
you know what? I almost want to forget fiat. I like the patterns in gold and silver
Me
much
too.
better,
Me
much
too.
better. And you know, I've been very aggressive on the long side there, and it's made up for some of my top picking in the dollar. So anyway, it was great to talk to you again, buddy. And
Pleasure, mate.
really, thank you so much for sharing your work with us.
No worries.
Julian Brigden, everybody, check him out. Go to his website, MI2 Partners, and check him out on Twitter at MI2 Partners.
Julian at MI2 Partners. Yeah.
Julian at MI2 Partners. Thank you, Julian.
Pleasure, mate. Have a good
All
one.
right, talk soon. Out